Verizon Communications, commonly known as Verizon, is a large telecommunication company in the United States. It provides a wide range of telecommunications and technology services to consumers, businesses, and government organizations. And Verizon plays a significant role in keeping people and businesses connected. Verizon has been struggling for some time now. Year to date, the stock is down almost 22%, and over the longer time frame, the stock has seen a decline of almost 43%. This is widely underperforming the major indices, but Verizon currently attracts many dividend investors looking for income, as they are yielding over 8.5%. Let's move over to QuantView, our stock insight tool, to get a broader insight into how Verizon is performing. And as we can see here, revenue has been flat for some time now, seeing no major increase in the last 10 years. This is very different though when we look at the free cash flow numbers, which have been very inconsistent. Pretty good for some years, but very bad in others. Another major factor in the decline of Verizon's stock price has been their ever-growing debt position, which has exceeded $150 billion in 2021. This compared to their EBITDA makes them sit at a ratio that is currently at 350%, which is 50% over our preferred ratio of under 3 times. And as we have talked about before, dividends are a huge appeal to investors seeking income. And Verizon has increased their dividends for 19 consecutive years now, and their 5-year dividend growth rate is sitting at just over 2%, which is nothing crazy, but to be expected with such a high yield. And dividends are something we'll take a closer look at in the next segment of today's video. But before that, if you want to get access to this stock insight tool and all of the valuation models that we'll be using in this video, be sure to check out my Patreon link in the description, where you can get your hands on our valuation spreadsheets for as little as $3 a month. And with that out of the way, in today's video we will be taking a 3-step approach to thoroughly evaluate Verizon and determine its fair value. Step 1. Margin of safety. In this step, we'll assess Verizon's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into Verizon's financial statement and assess critical metrics and ratios. In step 3, we'll be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of the business. And this step allows us to understand whether the stock is overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of Verizon as an investment opportunity. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll be looking at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. Where we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. As you can see there, EBIT has gone from just under $32 billion in 2013 to just over $31 billion in 2022. And this gives them, because they have some up years and some down years, a EBIT growth of just 2%, which is no change in the margin of safety. The margin is not looking that much greater either, going from 26.5% in 2013 to just under 23% in 2022. This is only a margin growth of 0.7%, which is no change in the margin of safety, looking as it's in the orange part of our scale. And the next metrics that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up very nicely, going from $2.09 a share in 2013 to $2.61 a share in 2023. Their dividend growth during this period has been sitting at only 2.3%, which is in the red part of our scale, indicating a 5% increase in the margin of safety on this metric. This dividend is supported by a payout ratio that's currently sitting at 53%, which is no change in the margin of safety on this metric. And the final 2 metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And as we have spoken about previously, this is currently sitting for Verizon at 3.5 years, in this case a 350% debt to EBITDA ratio, which is above our preferred ratio of 300%. And for us, that indicates a 5% increase in the margin of safety, seeing as this ratio is way too high. The return on invested capital for Verizon is currently sitting at 6.3%, which is once again in the orange part of our scale, indicating no change in the margin of safety on this metric. It's not looking that great so far for Verizon, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of Verizon going from 2013 to 2022. Their average growth rate in their free cash flow has been sitting at just over 14.5%, and I'm projecting their future free cash flow to grow by 6% annually for the next 10 years. So with this percentage, we'll be determining the future free cash flow for Verizon and determining a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $309.4 billion. And to get to our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $135.7 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $32.28, which is an upside of 2.5%. The second model that we'll be using is the dividend discount model. I've imported dividend payouts of Verizon going from 2019 to 2023. Their average growth rate in their dividends during this period has been sitting at 1.7%, and I'm projecting all of their future dividends to grow by 1.5%. I will once again be using this discount rate of 8.5% in this valuation as well, giving us a price per share out of this model of $37.85, which is an upside of just over 20% out of this model. The next model that we'll be using is Graham's revised valuation formula. In this model we take a look at the earnings per share that Verizon is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get an intrinsic value of this model of $32.80, which is an upside of just over 4%. And the last model that we'll be using is the mean reversion theory. In the mean reversion theory, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported dividend of the past 5 years, and on average the yield has been sitting at 4.85%, while the current yield is sitting at way above that, sitting at 8.62%, indicating that's undervalued on this metric. Doing the same with the PE ratio, on average in the past 5 years it has been sitting at 10.28, while the current PE ratio is sitting at only 6.29, indicating that it's once again undervalued on this metric. This gives us an intrinsic value of this model of $53.71, and this is an upside of over 70%. This is mainly due to it being, on a relative basis, pretty cheap compared to its historical averages. But with all of these valuation models out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported discounted cash flow, discounted dividend, Graham's valuation, and the mean reversion theory price per share, giving us an average of $39.15. A margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the dividend growth, and adding another 5% for the debt to EBITDA, giving us a margin of safety of 35%. And applying this margin of safety, we get a fair value of $29, and with the current price of $31.46, this leaves us with a downside of almost 8%, indicating that it's currently, per our valuation model, a sell. But keep in mind, if you would be using a different margin of safety, so let's say 20%, it would actually mean it's undervalued, so it depends on what you prefer, but we on this channel use this 35% margin of safety. And that wraps it up for this video. If you want to get access to this valuation models and the stock insight tool that we've used earlier in this video, you can check out my Patreon that is linked in the description. And if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.